Hello everyone, it is Sterling here from Day Trading Forex Live, and we're back for the 14th month in this series. This is the June 2016 month-end review. We go through every valid trade during the month of June on the euro dollar and the pound dollar. I don't cover any other pair because the levels that we select in the members area are the euro dollar and the pound dollar, and while most members trade other pairs, those are the pairs that we keep track of results on, as that gives a sample size for you guys to look at as an indicator of the strategy. So what I want to walk through a little bit more in this video that I haven't done in the past videos, I'll get questions, and I think it's mainly from people who listen to maybe 2 minutes of a video and then make a decision or make an assumption based on that. I'll get the assumption as to, what is the true validity behind the trade. In other words, most people that watch the video understand that the level is pre-selected, and that's what I'll show you here in just a second. But what people don't understand is that the entry is mechanical. And I cover this every video, but most people watch, our attention span in the US, our attention span in most of the developed world is about as long as a goldfish. So the time of a video watched is often, a quarter of the video or 30% of a video at best. And we have we have statistically at DTFL, we have pretty high watch rates as compared to most of the other market, but still, most people, they don't get to see the whole video, so they don't see the entire thing behind it. And that's what I want to cover here, because our entry is literally, if I were to come to you and I were to say, whatever your name is, what is 1 + 1? If you come to any other answer other than 2, that's a wrong answer, okay? And that is the best way I know how to illustrate the entry that we teach. It has mechanical criteria that is either satisfied or it's not. And so if you combine that with a pre-selected level, it's like asking, once the market gets to that level, what is the answer to 1 + 1? It either is the correct answer or it's not. It either is a valid entry or it's not. And that's why we can say for certain it is a valid trade or it is not a valid trade. That's what I'm going to cover a little bit in these videos, and I'm going to walk through this specifically with the first trade of the month. So the first trade of the month was on the 1st, and we started out the month with losing trade. Just to give you guys a little spoiler, the month we had our worst month in the last 13 months last month, and it was basically a break-even month. It was 0.3%. That was our worst month that we've had in this series. This month we had a profit of 8.25%. Again, that's trading 2 pairs and using 2% risk per trade. Okay. June for me was actually a really good month. I only trade the New York session. Any trade that I cover during the European session is a trade that I did not take, because I only trade one session, which is the New York session. And during the New York session, we actually had a 100% hit rate on our trades, and it ended up with a 14.25% gain during New York. Like anything, some months New York's going to be better, some months London's going to be better, some months you'll see more trades, some months you'll see less. Like anything, there's no perfect mean that it stays at. It will fluctuate, and New York just happened to be the better of the 2 months, better of the 2 sessions this month. But let's walk through this. So the first thing to understand is level selection. The levels are pre-selected. So I don't just say I'm going to trade in the 4,500 area, or I'm going to trade in the 4,290 area. I give you a exact level down to the pip. The reason I give an exact level down to the pip is because the entry requires that, because it also has mechanical criteria, and that's how we get it to be like asking what is 1 + 1. Again, it's either a right answer or it's a wrong answer. So the first trade that we had was from 44.42, and it was a long setup. So you can see that level was listed. Again, not only is it listed in a written form, it's also in a video that is time-stamped in YouTube. No way to go back and edit that. It's either listed or it's not. So again, 44.42 there. And so that was our one level on the day that had a setup, and it was a lower level. So we came into 44.42. Excuse me. One spot 44.42. This is on the pound. I think I said euro earlier. So 44.42. Again, started out with a losing trade this month. This was during the London session. And I'm going to walk through some basics with the entry. And I'm going to also walk through, and I'm going to give you guys a link below this video that directs you to information on the confirmation entry if you want to look at that as well. So that will help to solidify the point I'm talking about and give you confidence in the month-end results as well. So the level was 44.42, exact to the pip, no, roundabout. And the reason we have to give an exact number is because a stop run can only initiate with the first rule being satisfied, and that is the manipulation point needs to break by 3 pips or more. So if it breaks by 2.9 pips, it is not a valid trade. If it breaks by 3 pips, it is a valid trade. And that's why I say that is exact mechanical criteria. Much like asking if 1 + 1, what the answer to that is. It either does hit the criteria, it either is right or it is wrong. There is no in between. There is no discretion in that. It either breaks by 3 pips or it doesn't. I don't know how else to say that in a way that conveys that idea any more than I just have. So this breaks by 4.3 pips. I don't care if it breaks by 3 pips or 300. It needs to break by 3 pips or more. As long as it's over 3 or larger, that's fine. The next rule that we have, or the next candle that we need to see, is we need to see what we term as a confirming candle. Now, in the case of a long setup, a confirming candle has 2, again, mechanical rules that either are satisfied or they are not. The first rule in a long setup is that the confirming candle needs to close above the body of the previous candle. So here was initially, this candle right here was our number 1 candle. This broke the manipulation point and started the stop run. So now we have the break taken care of. We don't have to see the market break the level again. If it does, that's fine, but it's not required because it already happened. The next candle does not confirm because it doesn't even satisfy one of the rules of the confirming candle. It does not close above the body of the previous candle. So originally, the market would have had to have confirmed above this point. Well, this candle sets a lower candle body high, and so now that rule is a little easier to satisfy because the rule states that, again, it must close above the body of the previous candle. So does the following candle satisfy that rule? Well, again, it either does or it doesn't. In this case, it very clearly does. It closes above the body, which is where that black line is. It closes well above the body of the previous candle. And then rule number 2 of a confirming candle is it has to close in the upper 1/3. This is, again, for a long, the direct opposite for a short. It needs to close in the upper 1/3 of that candle. Again, a mechanical measurement that you can either validate as being accurate or being satisfied or not. The entire width on this candle, we measure wick to wick, and it is a 13.7 pip spread. In other words, the distance from the high to the low is 13.7 pips. So if there was any question as to whether that rule is satisfied, for example, if the wick looked like this, if you had a long wick like that, or I should say if you had a wick like this, you might want to measure that to make sure it's in the upper 1/3. Now this is very clear. It very clearly does close in the upper 1/3 of that candle, but let's just do this for repetition here. So 13.7, that's the entire length of that candle, again, wick to wick. And then you just divide by 3. That gives you a third. A third of the 13.7 pip spread is 4.56. So let's just round that up to 4.6. And that would mean that the market needs to close in the upper 4.6 pips of this candle. So as long as it closed right here where my cursor is or above, it would be a valid confirmation candle. It would again close above the body of the previous candle, and it would also close in the upper 1/3. Do you see why I say, being that the entry is mechanical, there is no way for me to look at this trade and say, no, I don't think that was a valid trade, and so, I'm just not going to count it as a losing trade because I don't think it's a valid trade. We have thousands of members of DTFL, probably hundreds of them watch the videos. This is covered in the video every single night in the daily market preview. It's also covered in the month-end review that you're watching right now. All of those members would immediately call me out and say, Sterling, that's a valid trade because it satisfies the rules. because again, 1 plus 1 equals 2, just the same as our entry, either is a valid entry once a level is hit or it is not. There is no ifs, ands, or buts. It either is an entry or it's not. Now, this is a very simplistic overview of the entry. There's many other aspects such as trade management, which are just the same, mechanical. There's something called candle count. How long can a count, how many candles can we have go in succession before the entry is not valid? We have ways to invalidate the level, things, again, many other aspects I can't cover in a 20-minute video, 30-minute video. And so that is the basic principle you'll see behind every entry I'm about to show you. You'll see those same dynamics behind every entry. And so whether it's a loser, whether it's a winner, it either is a valid trade or it's not. And so if you combine that with a pre-selected level, it doesn't matter whether it's a loser or it's a winner, there's no way I can make it look better or worse. It is what it is. And that's why these results are so accurate, because it cannot be changed if it's from a pre-selected manipulation point. I don't know how to explain that point in any more depth or in any more clarity. So for anybody that has questions as to the validity of these setups, if you don't get that, then I would recommend finding a new career choice. On a serious note, we start out with a 2% loss. We get stopped out of that trade. We start out negative 2% on the month. I'm going to go through the following trades a little bit faster so this doesn't take 2 hours to get through a video. Next trade was on the pound. It was a pound a pound short, and it was from 45.74. Now I have to cover a rule here before I get into this trade. Let's just draw the level, 45.74. I list levels that are within the average daily range plus maybe 10 or 20%. I don't list levels 500 pips above the price and 500 pips below the price just because the market could happen to go there maybe 3 times a year. It could run that far. I list levels that are at the average daily range or beyond it by maybe 20%. And that 98% of the time, that'll cover the levels that we have. Now, what you can do when we exceed that number is if we have previously been closer to that area, you can go back and look at previous daily market previews and say, was that a valid point in the past? So at the time of the daily market preview this day, we were nowhere near this level. It was not a listed point because it was well outside the ADR. Well, 2 days earlier when I was doing the daily market preview right around here, remember we were much closer. The distance from here to here is 75 pips. So we were much closer to that level and we were actually within an ADR length. And that was on June 1st. So if I pull over June 1st again, you'll see that on June 1st as an upper manipulation point, we had 45.74 listed. And the reason behind that is walked through in the video as to why it's a valid point. And so on the 3rd, once we exceeded the ADR, you go back, you look at previously valid points, that was the only valid point in the area. What makes that even a more simplistic selection of the level is that, again, there was absolutely nothing else in the area. There was no other possible level to consider. There was nothing else in the area. That's why it was selected on June 1st. That's why here on the 3rd it was a nice level for our second trade of the month. This started out our 100% hit rate during the New York session, and the same basic rules apply. Do you get a break of the level by 3 pips? Well, this candle breaks by about 7, maybe 8 pips. Now the second rule, confirming candle. Does it close in the case of a short? Exact opposite. Does it close below the body of the previous candle? Yes, that either does or it doesn't. That very clearly does. Second rule, does it close in the lower 1/3 of that candle? Well, let's measure it. High to low, 26 pips. What's a third of 26? Well, a simple way to break that down is a third of 24 is 8, 16, 24. So a third of 24 is 8. And there's a remaining 2 pips. What's a third of 2? Well, a third of 2 is 6, 6, 6 repeating. So that would be 8.6. 8.6 is a third of 26. You can check your calculator if you're not sure about that. So if this closes in the lower 8.6 pips, it's valid. Well, here's 8.6. That's right up here where my cursor is. So anywhere in this lower area, from the low of the candle all the way up to 8.6 pips, if it closed in that lower 1/3, it would be valid. This only closes 4.5 pips off the low, So it's well into that lower 1/3. Therefore, it's a valid entry. We take the pullback at, again, the mechanically required point. In this case, just to give you the number, okay, it closes more than 23 pips away from the high, so we'd be going with the standard 25 pip stop. And therefore, we take the entry when it hits 20 pips from the high. Again, all mechanical, and therefore the entry would have been at 45.62. And from 45.62, 25 pip stop, 50 pip take profit, runs off 62 pips on the first run, therefore hitting our full take profit relatively quickly, producing a 4% trade, taking us from down 2% in the month to up 2% on the month with that 4% gain. 2% risk, 4% take profit, again, takes us up to a total of 2% in the month since we were down 2%. Next trade was on the euro, and it was over the weekend. This was on the 8th, and this was what we term as a backside trade. And it's backside, just as the name implies, if we are below a level. So the level was 1378. So if we were below that level when I did the preview, I do the daily market preview around midnight right here. Trading starts at 2 o'clock, so I do it a couple hours in advance. So the reason this is called a backside point is because it is where we intend to trade off the backside of it, or the other side of that level. And so I'll drag over the preview from that day. This was again June the 8th. And you'll notice that on this day, it was actually highlighted in red, one spot 1378. Now, for those of you that are members, you'll know why that was highlighted in red. And if you go, you want to go watch the preview, you can actually listen to what I was saying in the moment before all of it occurred. But the point I made and why I highlighted it in red and put an asterisk there and said, please refer to the video, is because we were using that point as only a backside long. Again, this is all done a couple hours in advance of the market. In this case, about, let's see, what would that be? About 6 hours before this actually occurred. But anyways, in order to use a backside point, some mechanical criteria has to be satisfied. We have to open and close beyond the manipulation point. In this case, we have to get above it. And then we have to have 2 consecutive candles, both open and close above the manipulation point. Once that occurs, we can then take a backside long off that point. That is exactly what happened. Again, 1 plus 1, does it equal 2? If there's any other answer, it's wrong. It's either valid or it's not. Same process occurs. We need to then see the manipulation point break by 3 pips. Does this break by 3 pips? Breaks by, whoops, I just covered it up. Breaks by about 4.3, so well over 3 pips. Does the next candle close above the body of the previous candle? Very clearly does. Does it close in the upper 1/3 of that candle? Again, very clearly does. This was already within the target area at the time the confirming candle closed. No pullback was necessary. The entry was taken, and the close on this was at the mechanical close of 5 p.m. or generally 5 minutes before 5 p.m. and that left a 1.25% profit, taking us up from 2% in the month to up 3.2% on the month. Next trade, this was a little bit of a gap. We went through a gap. We started to get a little conservative on level selection because of the coming Brexit. So we actually skipped forward a few days here to the 14th, and this was a trade here on the 14th. It was a pound long on the 14th from the level of 41.22. Again, 41.22. And so to walk through this point, we'll drag over the daily market preview from that day. Daily market preview, June 14th, 2016. Lower level, 1 spot, 41.22. Same thing occurs. We come into that level here at the start of the session. This is a single candle stop running confirmation. It satisfies the rules of both a stop run, in other words, it breaks by 3 pips, and a confirmation candle. It closes above the body of the previous candle, and it also closes in the upper 1/3 as well, therefore satisfying the rules of both, and the entry is taken when the next candle pulls back. Now this trade, the entry would have again been taken 20 pips from the low, which would have been at 41.27. If you factor in a 1 or 2 pip spread, you either got filled at 41.28 or 41.29. Let's just go worst case scenario, say 41.29 on a 2 pip spread, and then this runs off and goes about 56 pips in our favor. Remember, 50 pip take profit in this situation, and hits our take profit by a few pips. Nice to see, considering all the times that we've seen over the last couple months, a lot of trades getting to few pips before the take profit and coming back, maybe tagging us a break even or taking back some of the profit. But full take profit trade, and that brings us from 3.25% up on the month up to 7.25% on the month. A nice 4% trade. Next trade was the next day. It was again on the pound, and this trade was from a newly created point. Now this is one that was from a newly created point. This was on the 15th. It was 42.01 on the 15th. What you'll notice about this day here during the month of June is that as I drag over the preview, you'll notice that, again, the level's 42.01 that we had, but you'll notice that we had no other upper point other than 41.77. So 41.77 was our only upper point because there was really nothing else in the area. And so remember, this is where the trade was right here, and I'll get to that in a second. But just to give you some reference, we had 41.77 selected. That was right here. And then I had nothing else selected above the price. And the reason behind that is that the next deeper level, this was outside the ADR at the time, which is why I didn't list it. But that was up here around the 42.88 point, 42.88.89. And so we had nothing within a close proximity to the price. So again, using as much mechanical criteria as we can, one rule we have for new level selection, this is not the end-all be-all, but one rule that we have for new level creation is that we cannot have a new level created within 30 pips of an existing level. So the distance from 42.01, because remember 41.77 never produced a trade. There was never a stop run and then confirmation down at that level, therefore no trade. We came into and created 42.01. Now, the distance from this point to the next upper point was 87 pips. So it satisfied the mechanical criteria of having enough distance to the next possible level. So we weren't too close to the next level. That mechanical criteria was satisfied. And then the next main point for any level that we're using is that wherever the market is turning from, and we measure from wick to wick, the market needs to turn and run the other way at least 30% of what the current ADR is. At the time of this level being created, the ADR was around 120, 130, somewhere in that area. You'd have to go back and get the exact number. But the point is, this runs from high, runs down about 64 pips. Okay, so 64, even if the ADR is, say, let's say the ADR was 150, which it was not 150. It was significantly below that. Times that by 0.3 to give us 30%. That's 45 pips. This runs down 63, 64, 65, somewhere in there. Just getting exact. Yeah, about 64 pips. This was probably 50% of the current ADR at the time. As far as that mechanical criteria being satisfied, it was absolutely more than satisfied. And given that there is absolutely nothing else in the area, it becomes the only viable point that we have. Something that we discussed in the preview this day on new level creation, if you go back and watch that video, on looking for a new level to form. So when we come back into it here, we wait for the same mechanical process to come together. Does the level break by 3 pips? This candle right here breaks by 3.5 pips. Level was at 42.01. This candle breaks up to 42.04 and 5/10, so it was a 3.5 pip break. And then not only does this candle create the stop run, but it also confirms down. Very similar to the long setup back here. Remember, this was a single candle stop run and confirmation long. This is a single candle stop run and confirmation short. This trade resulted in a 3% profit because we always close out, again, a mechanical criteria. We close out ahead of any news that is capable of spiking the market more than 20 pips, which the FOMC very clearly is. And I know a lot of you guys ran down and hit a full take profit because it did hit a full profit before the news. But I wanted to be a little more conservative on this one, and I did see some people, in all fairness, that were closing out at 2%, about 15 minutes ahead of the news, which was really conservative. So I split the difference on this and called it a 3% trade. Again, I know it ran off and hit a full take profit, but that's why I'm not calling it a full take profit trade. I'm calling it a 3% trade, as I would have, the conservative approach is to close out a few minutes ahead of FOMC, which was closer to 3%. That takes us from 7.25% up on the month to 10.25% on the month. Next trade was a loss, and we actually skipped forward. So things got a little hairy ahead of Brexit. We got really conservative ahead of Brexit, and then things after Brexit were obviously a bit more out of the norm as well. So we actually skip over here to the 28th, and then we had a lot of trades between the 28th, 29th, and 30th. We had a total of 5 trades between those 3 days on these two pairs, which for us is a fair bit of trades. The level that we had on the 28th was the 1 spot 1073 level. It was on the euro. And so here's the euro on 1 spot 1073. And I'll drag over the daily market preview from that day. You can see that 1 spot 1073 was a valid upper point at that time. And so we take and go over to the euro on the 28th of June, 1073. This first stop run here, you might say, well, Sterling, there was a stop run and confirmation here first, wasn't there? Well, let's do the mechanical measurement here. Did it break by 3 pips? You can see there it only breaks by 2.4. Therefore, this stop run and confirmation was not valid. The stop run and confirmation cycle that was valid was here. Stop run, this is our deepest of the stop runs. 2 candles later, we get our confirmation. At the close of that confirming candle, you're only 9.6 pips away from the high, which is within our target area, and therefore the entry is taken immediately. From that point, I know some of you guys ran off, got to break even. It wasn't, we moved to break even at a mechanical criteria, a mechanical point, and this did not hit the point for me. And so that's why I'm counting this as a full 2% loss. That takes us from 10.25% up on the month to 8.25% on the month. Next trade was the next day. It was also on the euro, and it was a break-even trade on the euro. It was a break-even trade on the euro from the level of 10.99. Okay, so 10.99 was the level, and we'll drag over the preview for that day. You can see that June the 29th, we had 10.99 listed as a valid upper level, and we come into 10.99 on the 29th. We'll just drag this point up here. And you come into 10.99 on the 29th, you get your original break here, you get your confirmation down. This trade runs off to the point where from the entry, you can see this one, when it had an entry 15 pips from the high, again, the mechanical criteria of depending on how far away the confirming candle closes from the high or low, that's what dictates what size stop we use. And so the stop on this one would have been 15 pips from the high at 1088. From 1088, it runs down and hits roughly 36 pips of profit. So this was a darn shame because the profit would have been at 40 pips, 20 pip take profit, 20 pip stop, 40 pip take profit. Unfortunately, got within about 5 pips of a take profit. If you factor in spread, came back, would have tagged you at break even trade there. A little unfortunate. But what we did have form is we did have above 10.99, the next level that we had to the upside was 11.78. So it was really the same thing that I talked about a few trades ago. The next level, it was at 11.78, which is a long ways off. It was quite a distance between those two levels, about 80 pips. And so what we did is we had this level here at 10.99. When we break by a few pips, the level gets tossed, or when we break a level at all with a candle body, a level gets tossed. The level can reform at whatever high or low is being formed, but again, it has to work down at least 30% of the ADR. This pushes down 50-some pips, which was actually well over probably 60% of the ADR at this time if you take away the move on Brexit. And even if you don't, was well over 30% of the ADR. This moved down, therefore solidifying it as a valid upper point. And then when we come into it for a backside trade here, we come in, get the backside stop run, again, breaks by 3 pips, and the next candle confirms up. That makes it a valid stop run long, and this trade runs off, hits a 2% profit when we have the mechanical close at 5 minutes to 5 p.m. Eastern. That takes us from up 8.25% of the month to up 10.25% once again. And then we have 2 more trades to close out the month on the 30th. The next trade was on the 30th, and it was a euro short from 11.27. Again, a euro short from 11.27. Now, for those of you guys that think when you're talking about new level creation, you think there's some, you think that new levels being created are only created on valid setups. That's an illustration of not understanding the strategy. That's also an illustration of just simply being lazy and not going back to the daily market or the month-end reviews. What you'll notice is that the newly created levels do not skew the results to the upside in a significant way. They should skew the results to the upside. Otherwise, why have newly created points? But what you'll notice is there's not a big deviation to the upside. And here's a good example. We had no other level in the area on the 30th. On the 30th, upper points on the euro, we had 1178 and we had 1242. And so I talked about this point in the preview, as I often do if a level is not quite valid. And I said if we push down 30% of the ADR, this becomes a valid point. We'll look to use it. That's what we had happen. We had a valid stop run. I can't, a trade is either valid or it's not. I cannot cherry pick a trade and say it's not valid if it's a losing trade, because does it break by 3 pips? Yes, it does. Therefore, the stop run is initiated. Then do we have a confirming candle down? Well, this candle doesn't confirm down, but the following candle very clearly does confirm down. It closes below the body of the previous candle, below the previous candle here. And it also closes in the lower 1/3. In fact, it closes right on its low. Therefore, that is a perfect stop run and confirmation. The entry is taken on the pullback, and the loss is taken about an hour, maybe an hour and a half later. That takes us from 10.25% in the month to 8.25% on the month. And then we have one more trade, and this was from 1085, again, a newly created point on the day. I believe we were actually in the room this day. And so I was picking this level live as a newly created point because although a level might be a newly created point, there are times where a level is, in fact, this is the way it really should be with any newly created level. It should be a very clear illustration that is a valid point. And so in the room this day, this was our valid point. And we had another stop run off that level and then a valid confirmation long here. A couple candles later, we get the pullback for the entry there on the euro. And so this setup here, the exit was actually on this candle for a break-even trade. The reason being is we had pound news. And so in the room at the time, I said if the pound reacts heavily, we will be closing out on this as we do with any news that's capable of spiking the market more than 15 pips. Wasn't sure what type of reaction we'd get with the pound. If you look on the 30th of June on the 1800 candle or the 11 a.m. Eastern candle, you'll see the pound dollar spikes down 185 pips in the first 15 minutes. So that's why we closed out on this candle as per the rule set and closed the month with a 8.25% gain. New York was actually a 14.25% gain. So I had for me at least, I had a pretty nice June for sure, but a combined New York and London session profit of 8.25%, which is what all the month-end reviews are. As I said at the beginning, some months you're going to have a lot of your trades during London, a lot of your trades during New York. It's going to vary. Sometimes you're going to have, one side might have stacked more winners than the other side, and vice versa the following month. Like everything else, it fluctuates. There are times where we have back in 2015, I think it was July, we had a 95% hit rate, but then you might go through other months and we might end up with a 40% hit rate. So while we average a hit rate of 60 to 65%, that number is going to deviate to one side or the other, obviously. As a conclusion to this month, 10 trades on those two pairs, 2 break even, 3 winners, 5 losers. So that gives us a total win-loss ratio. If you take this here and you go 5 divided by 8, which is the total number of trades, that gives us a win-loss percentage of 62.5%. And out of those, or with that win-loss ratio being positive, we also had a positive actual reward to risk. I'm not talking about what you start out with. I'm talking about actual. Our actual reward to risk on these trades was 1.4 to 1. And that's pretty common. We had a pretty common month here, although I like to see more trades. 2015 historically had just on sheer quantity. I'm not talking about quality. I'm just talking about quantity. The 2015 year had on average probably 30% more trades per month. And we've just seen less trades on average. Now, that is, again, like anything else, something that goes up and down. Some months you're going to see more, some months you're going to see less. And anyways, not only is the hit rate expectancy positive, but the real key to successful long-term trading is the reward to risk ratio. Even if you won 50% of the time, so take out, the 65% hit loss rate or win-loss ratio, just cut it down to 50%. Even if you win 50% of the time with a 1.5 to 1 or 2 to 1 reward to risk ratio, you can be extremely profitable long-term. If you're worried about hitting home runs in this market, guess what happens? The people that hit the most home runs tend to have the most strikeouts as well. Why is that? Well, they're going for the home run. And in trading, where traders get tripped up is instead of hitting your doubles, your singles consistently week after week, month after month, year after year, and in a few short years, they'd be where they want. They'd be in a position to potentially start taking a profit from the market, getting close to living off the market. Instead of that, they keep going for these home runs. So they have a couple months of profit, then all of a sudden they wipe themselves out in a week. If you're interested in learning a long-term strategy that is consistently profitable through any type of market, we've seen the DTFL bank trading strategy produce in any type of market. We've seen it produce through the 2009 when the stop run was consistently doing well through 2009 through 2012. When we revamped some things, added cycle into it, we did well through extremely stagnant markets, which was almost the exact opposite. And through some of the more volatile times, we've seen the strategy do very well. And in some of the most stagnant times, we've seen the strategy do well additionally. So before you become a member to DTFL, what I would encourage you to do is email us. Find out a little bit about the strategy. Find out a little bit about how we teach, because a lot of people are really not geared towards the education style that we have. They're really not in a position to where they should be signing up. If you're not at the point where you're ready to commit to a strategy, if you're not ready to stay disciplined, stay patient, if you're still the gunslinger type, you're going for the home runs, you think there's some magical EA out there, then I would encourage you not to sign up for DTFL. But before you do sign up, I'd encourage you to, again, find out a little bit about us. And if you're not in the position where you're ready to just commit and learn a consistent strategy that is not necessarily there for hitting the home runs, but is there for the consistent, steady profit, which is ultimately what creates profitable traders. If you're still kind of in that new mode of searching for the magic one-hit wonder, then we're probably not the service for you. But if you're at the point where you're ready to settle down, get disciplined, learn a strategy that has produced consistent profit through any market and through any and all markets, then I'd encourage you to take a look at daytradingforexlive.com. Shoot us an email at support@daytradingforexlive.com or daytradingforexlive@gmail.com. Either will go to the same location, and I'd be happy to field any questions that you may have. That will do it for this video. I will see you guys back for the next one. Until then, happy trading.